Hello, it's Jack here at System Trader, and in this video I'm going to talk about permanent portfolio, which was proposed by Harry Browne. The portfolio is very simple, as we can see here. It's having four pieces, 25% each. We have stocks, which historically, among other asset classes, is giving us the best returns. We have gold, which is especially good during periods of bad inflation. We have long-term bonds, and we have cash. So basically, that's the whole idea behind this investment portfolio. We are not trying to predict or to forecast anything on the market. The only thing we are trying to do is that all these weights will be at these levels, 25% each. And to do so, at the end of each month, we are checking if any of these components has increased or decreased by more than 30%. So let's imagine that in the last months, stocks were having a very, very great time and they increased by more than 30%. Then we are selling at the end of the month some portion of stocks to make sure that they are again at the level of 25%, and we are buying other components. So after whole operation, we have four pieces, 25% each. And let's see how such portfolio has performed in the last 50 years. And I'm talking about 50 years because going before 1970s is meaningless because gold prices were linked to American dollar. Therefore, we will see how it performed in the last 50 years. In this column, we see the results for our portfolio, and in this column, we see our benchmark, which in this case is S&P 500 index, 500 biggest American companies. And we see that the compounded annual growth rate for our portfolio is over 9%. And of course, stocks are a bit better because they are over 10%. If we take inflation into account, we see that our portfolio on average was making 5% over inflation each year. But the big difference is in the maximum drawdown because our portfolio at the worst moment had when it was losing over 12%, whereas stocks were losing over 55%. Also, here we had to wait less than 300 days to go through this maximum drawdown, whereas for stocks it was over 1600 days. And also the volatility of permanent portfolio is lower. It's below 8% on average if we take it in the annual terms, whereas for stocks it was always almost 17%. What we can see also here is that we can check all the month for each year to see how it performed. And for example, we can see there that 45 years were winning years and only 5 years during this 50 years period were losing. So we can see this also here on this chart. And also we can see, for example, the performance, the equity line for this 50 years period. Okay, now because we can implement such portfolio in easy way using ETFs, I built a portfolio which is using 4 ETFs with these following symbols. We have cash, we have gold, we have bonds, and we have stocks. And let's see how such portfolio, which is now just mimicking, let's say, the real life portfolio, how it performed in the last years. And we can go only to 2007 because the ETFs were not before that time for this particular portfolio. But still we have 14 years time to see how it was working. And basically we can see that our starting capital $1 million. We have at the end of June 2020 we have 2.5 million. The compounded annual growth rate was over 7%. For S&P 500 it was again a bit higher. but we are again above inflation, and this is a good news. Over 5% on average each year, our portfolio was making a profit. The maximum drawdown using ETFs was slightly higher than in the previous simulation, but still quite reasonable, 14%. And also the maximum drawdown, it was lasting for over 500 days. But the standard deviation, the volatility of such portfolio was really very low. It was less than 6% versus almost 18% for the S&P 500. So this is a great improvement. And we can also see the monthly returns for our portfolio. And as we can see, 3 years during that period were negative. But for example, a very difficult year, 2008, it was having a small profit, but still a profit, whereas the majority of other investments were losing. And also in 2020, with the COVID-19 situation, we see that in February and March we had a slight small losses, but till the end of June, our portfolio is making almost over 9% profit, which is really, really great. And here is our equity line from 2007. So all in all, it's a very simple portfolio, and I think that for many investors, it's a good way to at least try it, because we don't have to put any complex logic behind. The only problem which I may have, or let's say even two problems with this portfolio, is that first of all, in this particular case, we are using mostly the American instruments. We are using American stocks, we are using American bonds. So if someone would like to have a better diversification, it's wise to use a global stock portfolio and global bonds. That's one comment. And another comment is that we are having in that portfolio a long-term bonds, which had a great time from the 80s because the interest rates were decreasing, which was a good moment for bonds. But now, because the interest rates are really on the bottom, if they will start rising, then it's a bit problematic for that class for that asset class. So therefore, just keep in mind that having a long-term bonds may not be such a great idea as it was in the last almost 40 years period. Okay, that's all from my side. Thank you for your attention. I encourage you to visit my website systemtrader.show/st, where you can get this software which I'm using here, and just give it a try. Happy investing. Bye bye.